morning. You're watching Business World Live. I'm Danie Laurel. It's 10:30 a.m. this Thursday morning in Manila. We are about an hour into the trading day. Let's kick off with our banner story. The country's budget gap widened to over ½ trillion pesos in the first half of the year. That's as pandemic-related expenses soared amid a fall in tax collections. You can see on your screens here data from the Treasury Department show the fiscal deficit swelled by more than 10 times to 560.4 billion pesos. That's from the 42.6 billion peso gap recorded in the same period of 2019. Now, despite the surge, the gap is still lower than the government ceiling of 751 billion pesos. State spending from January to June jumped by over a quarter to 2.01 trillion pesos. That's from 1.59 trillion pesos 1 year ago, mainly due to the disbursement of cash aid to poor and low-income families. The spending fell short of the program 2.2 trillion peso target for the period. Meanwhile, revenues dropped 6% to 1.45 trillion pesos. Tax collections dropped nearly 12% to 1.21 trillion pesos, which was partially offset by a rise of 42% in income from non-tax sources amounting to 237 billion pesos. Total revenues exceeded the target of 1.45 trillion pesos. But for the month of June alone, the fiscal gap swung to a surplus of 1.8 billion pesos. That's from a deficit of nearly 42 billion pesos last year. Security Bank Chief Economist Robert Dan Rosa said the surplus in June could just be temporary, as the government is expected to shell out more money to stimulate a battered economy. Now, for Union Bank's chief economist Carlos Asuncion, the widening of the gap would likely depend on the amount of the government stimulus package. He says government spending will be a key component for the economy's recovery, noting that infrastructure projects have to adjust accordingly to help keep the economy moving and eventually stay afloat. Foreign investments to the Philippines, meanwhile, plunged to an 11-month low in the month of April. That's as the pandemic rages on. FDI net inflows in April dropped to $311 billion. That is a 68% decline year on year and a 38% slide from the month prior. April inflows are likewise the lowest since the $280 million that entered the country in May of 2019. The Bangko Sentral says the slowdown in FDI flows reflected sustained weakness in global and domestic demand prospects. Investors are seen keeping investment plans in the back burner for now. That's amid the uncertainty brought about by the coronavirus crisis. For the first 4 months of 2020, FDI net inflows slid by nearly a third to $1.9 billion. That's from the $2.9 billion recorded in the same period of last year. RCBC's chief economist Mike Ricafort says the weakness in FDI inflows was mostly due to the lockdown restrictions in the Philippines and in the other countries that are major sources of our country's FDI. But he says the worst might be over for the country's investment prospects. That's as lockdowns began easing around the world. He said there is one thing that will help improve investor sentiment, and that is certainty in the terms of the country's tax reform measures. For one, the proposed CREATE bill is seen to encourage more investments by lowering corporate income tax rates while streamlining incentives for some foreign investments. Checking in on the markets with me, but let's kick off with the local currency. We're taking a peek at the peso, which is actually weakening a touch, but still rather strong. It is at 49.411, so still definitely at the 49 level. And even BDO's Jonathan Rabelas, he's of course the chief strategist of BDO, saying that support does exist at 49.3. But he expects the range to be within 49.3 to 49.7. So still some room to depreciate there. But he does mention that if we do break those 49.3 levels, we might be seeing our currency strengthening even more. But this, of course, comes amid our last FDI print and also the reaction to that. Now, let's take a quick peek at some global stocks first and what is going on around the world. You can see on my terminal here that the US actually did have a bit of a rally. That was the fourth straight day of rising. There's still optimism. You did have the S&P 500 rallying overnight. That was closing at a 5-month high. The Dow Jones, you can see they're above 27,000. This on the back of a new spending bill over in the US that is being mulled, possibly extending the unemployment benefit. So even more fiscal stimulus to come possibly. Another good development on the virus front, you've got Pfizer. Those shares rallied after the US government ordered up to 600 million doses of a vaccine candidate against COVID-19. But you can actually see over in Asia Pacific that we are having a bit of mixed doubts. There is another issue on the forefront, and that is the escalation of tensions between the United States and China. China is being watched very closely here, and you can see that now as of 10:23, the Shanghai Composite down by 1.8%, Shenzhen as well slumping by 2%. Now, this amid the news that the United States ordered China's Houston consulate to close yesterday, and that had actually already hit the Hang Seng yesterday. Another issue is the American diplomats who are in Wuhan. They're preparing to leave after China vowed to retaliate for that. So a lot of things going on in Asia. Shares in South Korea and Australia slipping. Japan is actually closed right now, as well as tomorrow for holidays. And still a lot of virus issues around the world. 50 million infections now, or more than that, in fact. Hong Kong and Japan hitting new highs in cases, as did Australia. Let's move over to our local boards. We are also opening on the back foot, and here we are below 6,000 levels. I really can't recall the last time we've seen that in recent months, even since the month of May. So we are slipping below 6,000. That is down by 2.3%. And this continuing the declines we'd seen already on Wednesday. We were down by 1.2%. And no big surprise here. According to analysts, it's all about the longest and strictest lockdowns we've seen in the world here in the Philippines, with more new cases. We've breached the 70,000 mark already in Tuesday. There were thin trades on the front yesterday as well. First Metro had already called this, saying that we are expected to continue trading sideways with a downward bias today. They did mention that investors are still very cautious, not just on the pandemic, but on President Duterte's speech, which will be, on July 27. So investors to remain on the sidelines alongside that. Meanwhile, First Metro also mentioning Malacanang had a statement of a possible imposition of more stringent quarantine if the COVID-19 infections reach 85,000 by the end of July. And that is what they're saying might be dampening sentiment further. Let's take a quick peek at some of our sectors here. Everyone in the red, save for mining and oil, which is still keeping its head above water. But you can see here services hit the most, down 3.1%, but properties, holding firms as well, feeling the pinch. Financials down by 1%. Now, speaking of financials, the BSP at least is trying to keep their heads above water and trying to continue support for our banks here. They did mention that they will be extending the effectivity of regulatory relief measures until March of 2021. They're also going to lengthen this depending on how the crisis plays out. I'm going to be pulling out for you some of our banks here so you can see how they are opening right now. As I mentioned, the whole sector is down by 1%. What are the relief measures that the BSP will be extending? First of all, they will be extending the higher single borrowers limit. So it was normally 25%. During the pandemic, they raised that to 30%, and the BSP will be continuing that borrowing, which is more than normal. They will also be reducing the maximum penalty if a bank has reserve deficiencies. And of course, they just had already announced the cut in the reserve ratio requirement for universal and thrift banks. Another development of the BSP saying that reports or documents can now be submitted via email without a need for physical signature, as long as these are accordance with the guidelines. Now let's move on to some specific stuff that we need to be watching out for today. One sector of which is, of course, the cement players. You've got Holcim on the forefront. They're saying that, this was a failed bid, of course, from San Miguel. They're set to remain a part of the global group of their bigger parent company, Lafarge Holcim. So this was, of course, originally a $2.15 billion sale to San Miguel, which was not approved by the Philippine Competition Commission. And you can see here San Miguel down by 1.8%. Eagle Cement, of course, which some analysts had mentioned might have benefited from this. This is, of course, another unit of Ramon Ang, which is unrelated to SMC, but that had slipped by 8.9% already this morning. Wholesome itself as well feeling the pain, down by 6.5%. Now, another one to be watching out for, MPIC. Let's take up a quick peek of that. You know, they had been funneling a lot of their funds towards improving the hospital unit. They're saying they're now planning to build specialized hospitals. And what do they mean by that? They're looking at children's hospitals. They're looking at cancer facilities and diabetes facilities as well. This was, of course, according to their chairman, MVP. He did mention this in Business World's online interview on Wednesday. They also said that they will soon be offering services through a digital platform. So they're actually developing a telemedicine platform, expecting that to be ready after 2 or 3 months. And now, saving the worst news for last, of course, we are taking a quick peek at Abs-Cbn, and it is still falling. There you can see it, down by 29.9% in early trade after 1 hour of trading. It had just resumed trade. It was off the radar for about a week since the shutdown of, or the non-renewal of its franchise application. And they are, of course, saying that they're still in talks with the creditor banks regarding their long-term debts, but they are saying that they're confident that they will be able to meet those obligations. They are cutting their investments in non-core activities, so they're focusing on revenue-generating businesses and businesses that do not require a legislative franchise. Relatedly, they also own the theme park Kidzania, and they said that they will be ceasing operations effective August 31. This as the coronavirus pandemic forces children to stay at home. And you can see that their deposits, their foreign deposits, are down by even more than that, 30%. GMA as well is actually down by 2.2% this Thursday morning. Now, more on markets later on in the broadcast with BDO Capital President Ed Francisco. Okay, let's check in on the biggest headlines we're watching this Thursday morning. The DICT is proposing a 13.5 billion peso budget. That's to implement its National Broadband Program next year. This is much bigger than this year's budget of less than 300 million pesos. Secretary Gringo Honasan says the country's need for faster and more accessible internet connectivity has never been more crucial. That's as the Philippines aims to mitigate the effects of the COVID-19 crisis. The National Broadband Program has 6 components, mostly dealing with digital infrastructure like fiber optic cables, cable landing stations, common towers, and satellite overlays. Recall that the DICT is pushing for a common tower policy, which means more than one telco can use a single tower, therefore increasing the number of subscribers served by each tower. The agency says improved digital connectivity is essential, not just in light of the public health emergency, but for the sake of national competitiveness and our country's ability to participate in the global digital economy. Now, Environment Secretary Roy Cimado insists climate change remains a top priority for the national government. At a virtual briefing on Wednesday, Cimado explained that the climate emergency poses bigger problems for the country than the pandemic. That is because of its existential risk for future generations and potential loss of biodiversity. Cimado then pledged that the government, through his cluster, will prioritize projects that will reduce long-term health impacts to both the pandemic and climate change. However, the Philippine Movement for Climate Justice noted that President Duterte seems to be backing off his renewables pledge. Instead, Duterte is now pushing for coal-fired energy in his home region. Renewable energy investment was, in fact, one of President Duterte's promises during his 4th SONA last year, but during his speech to troops in Sulu last week, the president said coal energy investment is required to spur development in Mindanao. Businesses may soon face permanent closure if lockdown measures continue. This is according to the Philippine Chamber of Commerce, who noted that half of its members in the country have already closed down. PCCI added that employment among those that continue to operate is now down by at least 25%. PCCI President Benedicto Yujico says the limited allowable operations just translate into losses for the companies that would rather close. That's why the chamber is now urging the government to allow businesses to resume full operations despite the fact, or the spike rather, in COVID-19 cases in the country. However, a World Health Organization official has recently called the Philippines' updated pandemic response, quote, a little weak, unquote. That's after cases in the country surged to 57,000 on July 14. Analysts are beginning to say that the recovery in the Philippines will be longer and more painful than expected. And with these expectations of a V-shaped, broad-based recovery now waning, let's check in on specifics with Ed Francisco, president of BDO Capital. Good morning, Ed, and welcome back to the broadcast.
Morning, Danie.
Sir, let's kick off with a lot of things to talk about here, but let's kick off with the banks. I know that you can't really quote speak specifically or comment on BDO, but we did get BPI earnings recently, and we are seeing a lot of assistance, let's say, from the BSP in terms of easing. But now that assistance might be turning into negative real interest rates, which might be go on further than was initially hoped for, which was just a temporary help to the economy. How long is something like that sustainable? More easing continuing before the margins of the banks start getting compressed?
At least in terms of the margins, even with the pause that the governor mentioned might happen, I think the banks are well positioned anyway. Our deposit rates are stable. So margin compression is not a big problem. It's really more, I guess, in general, it's really the concern, will the banks really opening their loan books totally? There's this fear. Some of the banks have this fear of lending still, I think, because of what's happening with, especially the SMEs, the higher NPLs. So despite having a decent margin, because of increased losses, you might still end up making losses for your shareholders. So that's the real concern. So alluding to what you said, is it really a V-shape? Is it a swoosh? And how long will the recovery take? And that's in the back of the bankers' minds.
Sir, will the loan growth that that everyone is hoping to happen, because now we have a lot of liquidity on the table and interest rates are low, people might be hoping to tap into that liquidity, will that make up for the increase in the provisions that have been set aside for the non-performing loans, for example?
Okay. At least when I just look at the published bank reports, no? So BDO, Equitable, PNB, Security Bank, at least we're all listed anyway. Because of the increased loan loss provisioning, in reality, a lot of the banks will be happy to break even now. Yes, our interest income will be much high, will be good. But because of the additional loan loss provisions, if we break even, we should be happy. So what does that mean? That the banks are really here doing a service. We're opening our doors to service borrowers, but it doesn't mean we're making money because of all these additional provisions. So the support for the governor is appreciated, lowering reserves and everything, all the liquidity and everything. But it's really also very challenging for the banks, especially if you're a shareholder. And that's why even when you look at the prices of the bank stocks, we've been pummeled really, significantly lower than the rest of the index, not yet recovering because of that overhang of the loan loss reserves, Danie.
Okay, sir, companies are now tapping the bond market, and a lot are doing that to refinance what were higher interest rates and possibly extinguish those loans. Will that be positive for the banking sector in general, or is that you're going to be losing the revenues that you should have gotten from higher interest rates because they're now paying, tapping into lower rates? But at the same time, as you mentioned, it makes it more stable. It makes banks have less risk in terms of collection. Is that going to be a positive? And also, will that contribute at least to the fee-based income if we're not, making more money on the loan income?
Okay. No, at least, first of all, at least the bond market, PDEX is done extremely well. We just had I think the sixth virtual listing for the year,
Mm.
and despite the ECQ, I think we've done 3 or 4 deals. So it shows you how resilient the capital markets are. Uh, what's happening though? This is the bond market is only open to the primest of the prime. So there are only around I think
Correct.
56 companies that are listed in the PDEX as compared to the tens of thousands of Philippine
Mm.
borrowers. So that's really for the primes of the prime. Yes, capex has been slashed, so a lot of it is refinancing. But if they need to raise more capex and need to tap the market, bond market, it will always be there. There's a lot of liquidity, and people will be interested. The question really is, it will it will give fees to the banks, yes, but then there will still be the SMEs and the middle market accounts who cannot tap the bond market, who can only borrow through the bank. So the bank should remain there, and I guess we're very bank centric. We will always be there anyway. So it's just a question of at least as a borrower, diversify your funding mix. Just
Mm.
do not rely on one bank. So you also have pricing advantage, and you can talk to several of them. And just in case one is a little bit more conservative, you will have another option. I guess that's my recommendation. Diversify your funding mix, diversify your banks also.
Okay, so as you mentioned, sir, most of these Reg S or dollar-denominated bonds are inaccessible for retail investors like ourselves. But you do have a lot of treasury bonds, for example, coming in, T-bills, and even local domestic corporate bonds. You've even got COVID-19 bonds coming out, sustainability bonds. Is there still room for bonds right now, given that the yields are already very, very low? I mean, there's still an outlook that it might get any lower, but will there be any upside, or is this just really a safe haven investment right now to be putting your money in, especially if interest rates na nga are already so low and it might even become negative pa?
Right. No, I guess in a way the Filipino investors are also very astute because the sweet spot now for even for retail is the shorter tenor, maybe 2 years,
Okay.
3 years. Although now a lot of the retail are investing in the recent RTBs. It's ongoing, right? It was up to 260 billion, I think, the other day. It
Mm-hmm.
shows you that we're going for 5 years because the RTBs are a safe investment. That's 2.625. So to diversify, you can go for some corporates that are priced at around 3%, a little higher because they're corporates, but they're also very safe, right? But still at the shorter tenor. So those are the pesos. The dollars, of course, you can get higher, but those are 7, 10 year, and some of it are perpetual securities. Also a very good name. So it depends on what you want to do. If you have dollars, you can buy
Okay.
dollar bonds if you're a private bank client. But for the traditional retail borrower investor, you have bank bonds, you have RTBs, government securities, and you have corporate bonds. So at least it's in addition to deposits, Danny.
Okay. Sir, talking about fixed income, let's talk about the A-REIT, which has now been priced at 27 pesos. It's actually lower than expected. The highest range was they initially above 30 pa nga, and then they went lower up to 29 and a half. What does that mean? Does that mean that the book building process, there was less interest, or not necessarily? Is this cheap? Is it expensive? How do we value this? Given the fact that there's so many risks right now in terms of tenancy, POGOs possibly leaving, BPOs also.
Correct. No, I guess of course it's really a case to case. The fact that this is Ayala land behind it, of course, with Mr. Bernardi and Mr. Toti Bengson at the helm, they're both very good professionals. So the portfolio they put in their A-REIT are good quality tenants. So that there's very little risk there.
Okay.
In general, the fact that they've lowered the price to the 27 is also a good sign that they're giving more upside to the investors. So the price talk was between 5 to 6%. So that effectively
Hmm.
means that the yield will be a little on the higher
Higher.
side. So which is good. I think they're very little risk to pogos anyway, and these A-REITs that they have are great. It's a start for the market, and I'm excited because that means that once this is listed, there will be more Double Dragon. You'll have the likes of SM, hopefully Robinsons, Mega World, the other real estate
Mm-hmm.
companies tapping the REIT market, and that will be another investor class or asset class that will be available for Filipinos and even foreign investors. So it's
So
good. It's good for
just
the market.
just for curiosity, because a lot of analysts have said that when the A-REIT was back on the table, there was a flurry, there was an exit from Ayala Land stocks in particular, selling off, rebalancing towards this A-REIT. Is that something temporary? Is this something that you will be seeing over time as more REITs come to the table? And does it actually is it what is the I don't know, a deciding factor for an investor to shift their money from the parent company into a REIT?
Okay. No, in the way the one way to look at the REIT really is it's really like almost like a fixed income
Mm-hmm.
instrument, right? Because of the dividend yield. So if you're torn in between just equity risk, like generally common stock, you make money out of dividends and of the capital appreciation. I guess before, because even real estate stocks and bank stocks have got hammered. Uh, Depends on how you look at it, half glass half full. If you're
Mm.
optimistic, then there's a big upside because they've been hammered. But on the other hand, if you're a pessimist, you're saying these stocks will languish. So I'd rather want steady income. I buy a REIT because you have that dividend flow. So depending on your attitude, you can at least you have the options of going
Mm-hmm.
higher potential yield or steady dividends, which the REITs would do. So I guess my recommendation is you can invest in both. If you're already in common stocks anyway, if you have more money, you can consider it so that at least you'll mix your recurring income, which will be great anyway.
Okay, sir, let's move on to the Lopez companies, and especially ABS-CBN, which has just come back to trading. Do you feel that there's been a contagion to the other Lopez stocks because of this issue, or do you feel that it's actually been well contained, especially given the fact that ABS has already said they're not going to be defaulting on any of their creditors? They're well positioned to pivot if needed.
Yeah. No, I think from a management perspective, they really have a plan A, plan B, plan C, right? So, of course, they have operating subs, they have Sky Cable, and there are other businesses that do not need a franchise. So those will deliver cash flows to the digital side. So as long as the Sky Cable franchise is also hopefully goes through and it's renewed this year, I think it's waiting for renewal this year. They should have other cash flows building up and with Carlo Catibak at the helm, he's a great professional. And he used to head
Okay.
Sky Cable. I'm a Sky Cable subscriber, so I'm very happy working with him. I'm happy with
Mm,
that. And then I guess your other concern was, of course, what got hit was probably Lopez Inc. because that's the parent.
correct.
So that's the parent. So that would have gotten hit. But the other companies, especially the power companies, they're Lopez related, but then of course they have their own with Picky Lopez and Giles Puno leading that with also in EDC with Mr. Tantoco. They're also great professionals. I think those are immunized. In fact, remember
Okay.
KKR just bought into First Gen
Right.
as a sign of good how attractive it was and the prices zoomed up since they've invested. So I guess that means you the you
Low
can ring fence
contagion. Yeah.
ABS-CBN, yeah, it's different. And then the other Lopez companies are going to go on stream and they're protected and they will have good income. So I'm very hopeful for that. For the ABS-CBN, because BDO is also a lender, but I think we're a lender to
Mm.
Sky Cable side. But the parent side, I think Union Bank and BPI as disclosed, I think they're talking, and I'm hopeful that they will be able to restructure the debt.
Okay, sir, we're running out of time, but I wanted to talk about the education stocks that you mentioned because
Yes.
I think it's very interesting to be talking about that. We actually have several listed education stocks, diba? You've got STI, you've got FEU, FINMA, the I people.
Yeah.
Just
Yeah.
from a general perspective, these were already not necessarily at the forefront. People were not really trading that. What's the incentive of people to buy into education stocks, and how is the coronavirus pandemic going to be changing their valuation or the prospects of them actually expanding, which was first of all what they wanted to be doing, the Yuchenko Ayala deal, for instance.
Yeah. No, first of all, what was interesting, I think there are tax loopholes in owning schools, education. The taxes are
Mm,
different. And maybe
okay.
that's why at one point you saw the Taipans or Konglos all buying schools, right? There is a tax loophole, so you can put some of your operating services, maintenance in schools. That's one. It's from a finance perspective. But I guess
Okay.
second, also from an altruistic perspective, it's great to invest in schools because those represent, of course, the demographic dividend. Those are our children. We want the best education. So that's why people invest in schools. I guess third, though, is in terms of investing. The story now, though, is that it's gonna be hard because with online education,
Mm,
there are parents who might consider not enrolling their kids, or their parents who are requiring or requesting for a huge reduction in tuition fees because it's online, it's not virtual. But from the school's perspective, there's a lot of fixed costs, and they still want to
correct.
do that. So there's that tug of war. But then in general, I guess schools should really be continuing growth because we have a lot of young people, and it's good that our schools are leveling up. Even our universities are getting recognized internationally again, right? So I think
Mm-hmm.
short term they're gonna get hit. Yeah, their tuition, their incomes will get hit. And we both are involved in, I guess you're the French embassy
Mm-hmm.
or the French business schools. I'm involved in ISM. I want them
Correct.
to reopen. We want hopefully a hybrid learning because that's what some of
Mm,
the parents are clamoring for. We want the foreigners outside to be given their visa so they can come back in and allow their children to come back in because that's still been an issue. But once they come back in, I think that will be do well because that will allow the foreign investors to come back here with their families and go back to life as normal. I guess post COVID, but we want the children back. We want education back.
okay, so definitely something that we're both hoping for, sir, especially as we,
Yes,
watch
yeah.
the education talks, not necessarily for, as you mentioned, it could be an altruistic play, but it could also be a very long-term play. These can pivot towards technology companies. Are also very linked to real estate assets. So thank you, sir, for those
Thank you.
insights. That was, of course, Ed Francisco, president of BDO Capital.
Thank you, Danny.
Thank you, sir. And that's a first look into the business day. Today is Thursday, July 23, 2020. Catch us again tomorrow morning, 10:30 a.m. I'm Danie Laurel, and we are One News.